The financial ceiling of stability. Stability feels responsible, measured, rational, a stable income, predictable cash flow, low volatility. These are markers of financial maturity. Nothing about them appears limiting. And yet, a structure designed to eliminate loss often eliminates the conditions required for growth. Nothing is broken, nothing is reckless, nothing is mismanaged. The system works. That is the ceiling. Financial stability reduces variability, income becomes predictable, expenses become controlled, outcomes become linear, risk is minimized, uncertainty is contained. The structure rewards preservation. Preservation feels intelligent. It protects against shock, against sudden contraction, against visible error. But preservation is directional. It points toward continuity, not expansion. Low volatility creates psychological calm. Predictability reinforces confidence. When cash flow is steady, the system feels secure. Security becomes the metric. But security is not neutral. It selects which outcomes are acceptable. High variance becomes undesirable. Irregular returns become suspect. Uncertain trajectories become irresponsible. The structure begins filtering reality. Only stable patterns are allowed to remain. Incremental growth is rewarded. Small increases, controlled adjustments, measured expansion. The structure normalizes linear improvement. Linearity feels disciplined. Each year slightly better than the last. Each step controlled. But linear systems rarely produce asymmetric outcomes. They are not designed to. Financial control reduces exposure. Exposure introduces volatility. Volatility introduces unpredictability. Unpredictability threatens stability. So the structure removes exposure. Quietly. Not because exposure is wrong, but because exposure conflicts with preservation. Intelligence strengthens this mechanism. Intelligence is designed to reduce ambiguity, to resolve contradictions, to restore coherence quickly. When a possibility introduces uncertainty, intelligence does not ignore it. It evaluates it, and then it often classifies it as inefficient. Over time, something subtle happens. The range of imaginable futures narrows, not because opportunities vanish, but because fewer of them survive initial filtering. Stable salary structures reinforce this pattern. Predictable compensation, fixed intervals, defined ceilings, income becomes bounded. The system adapts lifestyle to match. Expenses align with stability. You still experience align with predictability, but it is curated. The entire structure harmonizes around continuity. You still evaluate alternatives, but they are alternatives that fit inside the current structure. Anything that would require structural reconfiguration rarely feels compelling enough to pursue, not because it is dangerous, but because it does not integrate smoothly. This alignment feels optimal. No extreme losses, no dramatic swings, no structural stress. Financial calm becomes the goal. But calm has a cost. It limits range. Risk minimization is rational. Reducing downside protects capital. But aggressive downside protection also limits upside exposure. When preservation dominates, multiplication becomes secondary. Not intentionally, structurally. The structure begins optimizing for what can be controlled: savings rates, budget precision, expense predictability, tax efficiency. Each improvement strengthens the system, but optimizing variables inside a structure does not change the structure's purpose. It only refines its stability. Linear growth remains intact. The system improves steadily, but never dramatically, because dramatic shifts require instability. Instability violates the system's design. Financial control feels like competence. It reduces anxiety, clarifies numbers, creates order. Order reinforces trust in the system. The more control increases, the more deviation feels unnecessary. Optionality quietly narrows. Preservation and expansion operate under different rules. Preservation reduces variance. Expansion tolerates variance. Preservation protects existing structure. Expansion stretches structure. A system optimized for preservation cannot simultaneously optimize for asymmetry. It must choose, and stability always chooses continuity. Low volatility environments normalize modest returns. They discourage extremes. Extreme outcomes appear reckless, unstable, unnecessary. The structure rewards what can be predicted. It penalizes what cannot. Over time, financial behavior adapts, not through fear, through coherence. The numbers look responsible, debt manageable, cash reserves healthy, income consistent. Everything signals safety. But safety is not expansion. Safety is containment. Incremental progress compounds slowly. The system becomes increasingly efficient, increasingly optimized, increasingly resistant to disruption. Resistance feels like strength. But resistance also blocks deviation. Deviation is often the entry point to growth. A financial structure that eliminates volatility also eliminates the possibility of asymmetry. Asymmetry requires imbalance, requires exposure, requires uncertainty. These conditions contradict stability, so the structure excludes them. Nothing signals danger. Bills are paid, savings accumulate, income remains stable. The system appears successful, but its design limits trajectory. Financial ceilings are rarely visible. They are embedded in structure behind many forms of stalled growth. The ceiling is not imposed externally, not incompetence. It emerges from optimization. Not fear. The more stable the system becomes, the more tightly bounded its outcomes. A narrowing control that occurs before awareness are inversely related. More control reduces variance. Less variance reduces possibility. Possibility requires deviation from the predictable. Predictability suppresses deviation. This is not about irresponsibility. It is about design. A structure built to protect capital will prioritize preservation over multiplication. It will favor stable income over volatile opportunity, predictable growth over asymmetric exposure, low risk over uncertain expansion. It will function exactly as intended, and that intention has limits. When stability becomes the highest value, expansion becomes structurally incompatible, not emotionally, mechanically. The financial ceiling of stability is not imposed by failure. It is imposed by optimization. The system performs efficiently, reliably, but within a bounded range. Nothing collapses, nothing signals urgency. The structure continues delivering what it was designed to deliver: predictability, control, continuity. And as long as safety remains the priority, the system will not produce outcomes that require it to stop being safe. A system optimized for safety will not generate expansion beyond its design. It will function, and that function is the ceiling.